Hello, my name is Michael Corcelli. I'm the Chief Investment Officer of Alexander Alternative Capital in Miami. We are at the conclusion of August 5th, a week of macroeconomic data. It's been a very, very interesting, important week in macroeconomics. Alexander Alternative Capital is a top-down researching asset management firm, and we actually look at top-down to figure out where the risk and growth is in the world macro economy. Then once we have a good definition of risk and growth, we apply bottom-up fundamental analysis to express our views. So some of the considerations for the week for the broader economy came out. The U.S. automobile manufacturer sales were down in July. They came in less than expected. That on the back of lower bond yields. Lower bond yields are driving the search for yield, and investors are putting their money into riskier assets like equities on a global basis. Um, some of the more similar phenomenon is how investors are choosing small and medium-sized companies to express their views rather than their larger counterparts. One of the interesting notes out this week came on the back of the European bank stress test results. Um, there was a couple of banks that showed that they would not be able to actually hold up during an economic crisis or a financial crisis. You know, not going to name any names in this. The European stock bank, the Euro stock bank index, fell almost 8% during the week. However, it had a strong close to the week, finishing only down 2%. Another surprise in European banking came when the Deutsche Börse Group announced that Credit Suisse and Deutsche Bank are being delisted from the Euro Stoxx banking index. The announcement's not the end of these banks or are going to cause a significant collapse. However, it does highlight a larger trend globally, how banks have less importance on the global economy, and they're not one of the gems that they used to be pre-financial crisis. They've been basically regulated to depository institutions, which most people feel they should be. Moving along, the European Central Bank announced this March that they were going to start buying corporate bonds. That program started on June 8th, and they're roughly buying $7.9 billion or billion euros of corporate bonds a month right now. That is fueling the issuance of global corporate debt. That corporate debt is being used to fund stock buybacks. Those stock buybacks are fueling multiple expansions. It's causing equity markets around the world to actually rally. This week, the reason we're bringing this up is the Bank of England also announced they're going to do the same. They're going to buy over $5 billion, 5 billion pounds, which is $6.5 billion of corporate bonds issued by UK companies. Why is this important? These central banks are basically buying up all the leftover bonds, and it's causing credit spreads to tighten. It's causing the borrowing costs of these corporations to plummet. The companies are supposed to be investing in growth, and guess what? They're not. They're actually buying back their own stock to increase earnings. So when we hear people on TV talk about, you know, the growing divergence between the haves and have-nots, the haves own stock. The have-nots don't own stock. They actually work jobs. And when the companies invest in increasing the revenues, these people make more money. They're not doing that. They're investing in buying their own stock back. So let's move on. After a lot of head scratching, I've been scratching my head all week long because economic data has been weak and financial markets has been very strong. The economy, admittedly, by us this morning live on our channel, the Alexander Alternative Capital channel, we reported on non-farm payrolls coming in at 255,000 jobs, a very, very, very strong number. It also showed some wage inflation. The wage inflation came in at 0.3% versus consensus estimates of 0.2%. Now, you'll ask, why is this important? A strong labor market in the U.S., a strong economy, strong consumption. This is a very bullish macroeconomic data point, and it comes on the back of the one from last month, which was also a very strong, coming in at 287. So the U.S. economy is still creating jobs, and employers still have confidence in the hiring, a very, very bullish sign. And wage inflation is the number one, and this is why I'm going to conclude, with this. Wage inflation is the number one precursor indicator that the Federal Reserve, the data-dependent Federal Reserve, uses to raise interest rates. They do it so that they can head off of inflation. So whenever wage inflation shows up, like it has, on the back of a good number, like it has, the Federal Reserve has confidence to raise interest rates. So, with that said, we believe at Alexander Alternative Capital that a rate increase in September is back on the table. If you look at the euro dollar futures, you'll see that there's a 25 basis points increase. We believe that that's going to come back into focus next week, and if rates are going to go up, the dollar is going to get stronger. It's going to put price pressure on commodities. It's going to put price pressure on equities, because the companies that are in these indexes are going to have a harder time converting their earnings made overseas into U.S. dollars. A strength in the dollar, weakness in corporate profits, weakness in the commodity markets. So keep your eye on that. Also, an interesting piece of research that was out this week had to do with the Japanese central bank when they announced their fiscal stimulus policy, which was about half the size that it was supposed to be, coming in at below 200 billion U.S. dollars. The JGB, the prices plummeted, and the cost of borrowing the debt spiked up. We're going to keep our eye on other countries like England, like the UK, because we feel that they're probably the most likely with the lowest rates to announce a fiscal stimulus policy. You definitely don't want to be in those when this happens. We also did a little bit of work on the Apple iPhone release. The Apple iPhone release is coming up in less than 1 month. We're not really that excited about the upgrade cycle this time. We feel that competition's been creeping into the Chinese market, which was the #1 fastest growing market for the iPhone. According to some inside sources that are close to this situation, Hawaii has really, really set themselves apart from some of the competition. A lot of Chinese people are enjoying a lower cost phone that is almost the same as the iPhone. So we expect about a 15% increase in the price of Apple stock going into the end of this year. In the past, in 2014, our numbers had been much bigger at 25%. So that, coupled with the fact that the options are more expensive this season than they had been a couple of years ago, we're not really that bullish on Apple going into the fourth quarter. Another piece of interesting news that came out this week is large cap gold mining stocks have outperformed their peers because investors want to own gold, and they want to own gold mining stocks, but they're afraid of being caught in a small cap liquidity trap, like that's happened in the past crises. If the lack of confidence in central bank policy continues, history should suggest that small cap mining stocks will catch up and start to outperform their large cap counterparts. So on a final closing note, we had a breakthrough in our machine learning neural networks this week. Our signal here is actually being computed and I'm going to get a buy or sell on gold. Did the signals suggest buy or sell this week? Bo, did the signal buy or sell?
Sorry.
Buy or sell?
I didn't run the